You know, when you look at a company's financial statements, you're really looking at a story told in numbers. But who decides what those numbers actually mean? Well, today we're cracking open the rulebook that dictates that story, International Accounting Standard 32. This is the standard that forces companies to be crystal clear about what they owe versus what they own.
So, here's our game plan for this explainer. We're going to start with the one core question at the heart of this whole mystery. Then, we'll dive into the official definitions of our two main suspects, liability and equity. After that, we'll investigate some sneaky instruments that are in disguise, see how these rules keep the financial story honest, and finally, wrap up with why getting this right is so incredibly critical for all of us.
Okay, so every single time a company raises money, whether it's by issuing shares or bonds or something way more exotic, it creates this fundamental puzzle that accountants and investors absolutely have to solve.
In that puzzle, that whole mystery, it boils down to this one powerful question. Is this thing a form of debt, what we call a liability, or is it a piece of ownership, what we call equity? That's it. That's the core question IAS 32 is built to answer every single time.
And make no mistake, this isn't just some boring accounting detail. The answer has massive, real-world consequences. It directly shapes how we judge a company's risk, its profitability, and its overall financial strength. Getting this wrong can completely mislead you.
So how do we solve this puzzle? Well, IAS 32 gives us a set of official definitions, clues really, to help us crack the case. Let's take a look at the tools of the trade for any good financial detective.
First up, what are we even investigating? A financial instrument. It sounds complicated, but it's really just a contract that creates a financial asset for one company and either a financial liability or an equity instrument for another. Think about a simple loan. It's an asset for the bank, but a liability for the person who borrowed the money. Simple as that.
Now for our first suspect, a financial liability. The magic words here, the biggest clue, is contractual obligation. This means the company has a binding duty it absolutely cannot avoid. It has to pay someone back with cash or something valuable. There's no choice in the matter.
And what about equity? Well, this is a completely different animal. An equity instrument represents a residual interest. In plain English, it's what's left over for the owners after all the debts and obligations, all the liabilities, have been paid off. It's a claim on whatever's left, not a fixed IOU.
Here is a great way to picture this. A liability is like your mortgage. It's a non-negotiable obligation to pay the bank a certain amount. Equity, on the other hand, is like owning the actual bricks of the house. The value of your ownership goes up or down depending on the house's value, but only after the mortgage is taken care of. One's a fixed claim, the other is a variable residual claim.
And this brings us to the absolute golden rule of IAS 32. It doesn't matter what a company calls an instrument, what matters is its economic reality, its substance. You can call something preference shares all day long, but if it has a clause that says you have to pay it back, well, its substance is debt. Substance always wins over form. This is crucial because it stops companies from dressing up debt in equity clothing just to make their books look better.
So how do we actually apply this substance over form idea? One of the key tools is something called the fixed for fixed test. It's basically a simple checklist for any instrument that gets settled in shares. You just ask, will the company deliver a fixed number of its own shares in exchange for a fixed amount of cash? If the answer is yes to all of that, it passes the test and boom, it's equity. If either of those variables can change, it fails and it's probably a liability.
All right, knowing the rules is one thing, but this is where it gets really interesting. Finance is absolutely full of instruments that are designed to look like one thing while actually acting like another. So let's unmask some of these common instruments in disguise.
Let's start with preference shares. I mean, the name has shares right in it, so it's got to be equity, right? Well, not so fast. These can be masters of disguise. Depending on the fine print, they can actually be liabilities hiding in plain sight.
And here is the dead giveaway. If a preference share is mandatorily redeemable, which is a fancy way of saying the company has a contractual obligation to buy it back, it's a liability. Why? Because that unavoidable duty to pay cash makes its substance the same as a loan. But if it's non-redeemable, the company has a choice, and so it gets classified as equity. One tiny feature changes absolutely everything.
But wait, it gets even more complicated. Some instruments aren't just one or the other, they're actually both at the same time. We call these compound instruments, and the classic example is a convertible bond.
It acts like a regular bond, but it also gives the owner the option to convert it into company shares.
So to handle this, the accounting standard basically tells the company to perform a kind of financial surgery. You have to split the instrument into its two parts. The piece that represents the obligation to make principal and interest payments, that's your financial liability. But the conversion option, that right to get shares, that's an equity instrument. And both of them have to be recognized separately on the balance sheet from day one.
So we've classified our instruments. Now what? Well, that classification directly affects how payments get reported and whether you can net assets against liabilities. Let's see how IAS 32 helps keep the financial statements clean and clear.
This is a big one. If an instrument is classified as a liability, payments like interest are treated as an expense, which reduces the company's reported profit. But if it's an equity instrument, payments like dividends are seen as a distribution of profit, and they come directly out of equity. This has no impact on the profit number itself. That is a huge difference in how a company's performance looks.
This brings up a pretty common question. If a company owes money to someone who also happens to owe them money, can't they just show the net amount on the balance sheet? I mean, it seems logical, right? But accounting has very, very strict rules about this.
And the standard is really strict here. You can only offset if two very specific conditions are met. First, you need a current, legally enforceable right to do it. And second, you have to actually intend to settle them that way, either on a net basis or at the exact same time. Having the option isn't good enough. You need both the right and the intent.
All right, let's bring it all home. We've looked at the evidence, we've examined the tricky cases, and we've reviewed the rules. Now, for the final verdict, why does all this financial detective work truly matter? Here is the bottom line. Getting the classification wrong can drastically warp a company's financial picture. It messes with key ratios like debt to equity, which lenders use to see how risky a company is. It can artificially inflate or deflate reported profits, and it fundamentally changes the signals being sent to investors about a company's true obligations and its financial health. And that's really the crucial takeaway. Understanding these principles in IAS 32 isn't about memorizing rules. It's about learning to speak the language of finance, so you can really understand the story a balance sheet is telling you about a company's promises and its resilience. And that leaves us with one last thought to chew on. Financial innovation never, ever stops. As new, more complex instruments are created, that core principle of substance over form is going to be tested again and again. So the question for the future is, will this principle always be strong enough to see through the disguise?